Good morning, everyone, and welcome to another edition of Your Daily 5, presented here on StockCharts TV. I am your host for today's show. My name is Grayson Roze, Vice President of Operations here at StockCharts.com, and it is wonderful to be back with you for another episode of the show. Every time I get an opportunity to host Your Daily 5 every couple months or so, I always like to tell people this is one of my favorite shows that we do on StockCharts TV. It is always action-packed, but you get a different perspective every day from a different analyst, and it's so fun to catch up on this one, especially at the end of the day, kind of see what some of these different experts, chartists, strategists, investors, traders are all bringing to the table. So I've got 5 charts with me today. And actually, that's a bit of a lie. I have 6 charts with me because I've got one bonus chart at the very end that I want to make sure we hit on as well. But we're going to have some fun today because we're actually looking at VTI. That's the Vanguard Total Stock Market Index. And we're going to do that from a couple of different perspectives. All 6 charts that I've brought with me today actually are looking at VTI. We're looking at the same symbol, the same total market index, but from a different perspective, using some different tools, different indicators, different time frames as well. So without further ado, let's jump right into it. Now, this is what I like to call the Stoplight Chart. And I've shared this in the past. I shared it yesterday as well out on Twitter. If you're on Twitter, you can follow me at Grayson Roze. But a lot of people, when they think about markets, we like to think about markets as either bullish, going up, or bearish, going down. But there is a very real middle case that a lot of people like to forget. Markets are not binary. They don't just go up or just go down. Markets can really drift sideways. They can move sideways in these kind of range-bound patterns. So I like to think of markets, especially in a time like we have right now, where we're testing some lows, we're moving lower, we're trying to bounce higher. We've got this choppy market that's been drifting lower and really sort of breaking the uptrend that we've seen in the last couple of years. When I think about a market like that, I like to think about it with this kind of stoplight mindset. So we can actually use an annotations tool on stock charts in either sharp charts or ACP, as we're looking at here. We can actually color the background of our charts with this kind of stoplight concept. Now, just like a stoplight, the idea is simple. If we're up in the green, hit the gas. That's the time to get aggressive. That's the time to be bullish. That's the signal that the market is making its way higher and might continue to do so all the way up to new highs and beyond. If we're trading down there in the red as we are right now, these are ugly times. These are the times to sit on the brakes. When we get up into that neutral zone, though, when we get up into that yellow, it's not necessarily the time to hit the gas and be as aggressive as we can, finding new trades, putting on new ideas. That's really kind of that cautious time. It's a time when we should approach things maybe a little bit slower, approach things with caution. Because again, if the light turns yellow, you're not hitting the gas and slamming on. You're kind of approaching that with some caution, kind of looking around, making sure that everything's going to be okay. So I love this kind of stoplight concept. And actually, a little preview, we are building this into a very unique indicator that's going to be out on stock charts later this year. So keep an eye out for that. We'll be sure to tell you about it. But think about your charts as a stoplight. Everything above a certain level is going to be good to go. Everything below a certain level is going to be ugly. And everything in between is going to be kind of that range-bound period where we're chopping around in kind of the neutral zone. Now, we are still below a downtrend. That's what that purple line represents, as you can see here. We are in a clear downtrend. We are testing some lows, sure, and that's a good thing. We're not really breaking through them rapidly. We are kind of testing and retesting those lows. We bounced off it a little bit, so that is, slightly reassuring. But at the end of the day, we're still trading down in that red zone. Now, on a very short-term basis, let's kind of zoom in. We're looking at a 15-minute chart. Super simple chart here. We just got the candlesticks again on VTI. The idea here is that these are our highs from August. When we did make that big move higher, that bear market rally, these are the highs, for the short-term highs that we put in mid-August. You can see the date there, mid-August. Since then, on the 15-minute chart, again, a very short-term view, we have been in a very strong, very clear downtrend. Simple idea here, until we get above, again, that purple line, until we can break above this downtrend in a meaningful way. We tried to get a pop above it here, but that really turned into a bit of an island reversal. Until we can get up and above through this downtrend in a meaningful way, maybe even test it and hold it and continue to move higher, this downtrend is in play. On a short-term kind of picture, this is a downtrend that I am watching closely, a move that I'm watching closely, some levels to think about. Now, if we zoom out, again, we're looking at the short term there. If we zoom out to kind of the intermediate term and the long term, though, this is a chart that I like to call my moving average focus chart. What you can see I've done here is actually faded out the price bars. We've shared this on the show in the past. What we've done, though, we've used some of the different settings in ACP to fade out our price bars and leave the moving averages, two key moving averages in particular, at full strength. What that does is it keeps us focused on those moving averages. Most of the time we want to stay focused on price, but with this specific chart style, this moving average focus chart, we want to sort of put price at the background, if you will, and focus on these moving averages that are really designed to help us see trend at different time frames. Now, we've got the 50-day, which represents the intermediate time frame to me, and we've got the 200-day in green, which represents the longer-term time frame to me. Again, this is my trading time frame. Yours might be different depending on whether you're a little shorter term or a little longer term. But for me, I like to use the 50 and the 200 as representations of intermediate term trend and long-term trend. The key idea here, both of these are continuing to move lower. Now, we did get that bear market rally, and we saw that intermediate term trend start to pick up. That was reassuring, but that has rolled over very clearly. That 50-day is continuing to head lower. The 200-day has been heading lower really since the spring. And so when we look at this chart, again, we're just trying to stay focused on those trends, use those moving averages to kind of help us think about trend at some different time frames really, really clearly. The long-term trend here still pointing lower, still moving lower. And the intermediate term trend as well has rolled over and is moving lower. So when I think about kind of the direction that we're going in, where the market is heading, those two-term time frames are definitely saying we are continuing to head lower. On top of that, we have that short-term time frame from the chart before saying we are continuing to head lower. So pretty much on all the time frames that I like to think about when I think about the total market and kind of where things are going, we are continuing to head lower. Now, our next chart, because I don't want to just make you so sad right off the bat, the start of your morning, I'm bringing you a bunch of bad news here. One thing that you can kind of get excited about, again, we're talking about kind of retesting those lows and actually not necessarily holding them technically down to the penny, but we are really chopping around those lows. That's one kind of bright spot that we've talked about. Another one is actually how stretched we are to the downside. So if you are a shorter term trader, you want to take advantage of a little bit of a bounce, the next two charts might make you feel a little better. What we have here on this first one is the distance from the simple 50-day moving average and the distance from the 200-day simple moving average. Now, these two indicators are available in ACP as part of our advanced indicator pack. It's a free indicator pack for StockCharts members. So if you look up our ACP plugins, you can install that one in a single click and actually get these indicators installed right into your experience. I like this concept because, again, we're looking at the chart before at the 50 and the 200-day. But what this indicator shows us, what both of these indicators are showing us, is that historically, the distance that we're trading off those moving averages, off those key time frame moving averages, these are really, really stretched levels. We don't see VTI get this far off the 50 and the 200-day very often. Typically, that can mean we might get a bit of a snapback rally. As you can see, that's what happened this summer. We got down to about these same levels. These orange lines are at 10% on the distance from 50-day moving average and 15% on the distance from the 200-day moving average. You can see that we're really, really close to that, 9% below the 50-day moving average and 13.6% below the 200-day moving average. Historically, that's pretty stretched. Now, it doesn't mean that we can't get more stretched. As you can see here in the COVID lows in early 2020, we got way, way stretched off the 50 and the 200. That was such a rapid collapse. But historically, These are kind of levels off the 50 and the 200 where we might start to see a bit of a bounce. So that is one thing to hang your hat on if you're looking for a bit of a short-term rally that you actually want to play, kind of something similar to what we had off those June lows. If you want to play that, again, remember that we are still in a downtrend until that sort of primary purple line, that primary downtrend on the daily chart that we looked at in the very first chart, until that breaks and until we get up into our yellow and then our green levels, the long-term trend is still going to be down. But that doesn't mean there's no opportunities for some of these short-term bear market rallies that you can play. So if you're looking for a bit of a snapback rally, this is one chart that I would be watching closely. Now, the other one that I would be watching closely is just think about these moves on a percentage basis. Again, remember that markets don't go in either direction in a very linear fashion. Markets go up, markets go down. Higher highs and higher lows are what define an uptrend. And when we have an uptrend, those indexes, stocks, anything you're looking at, they move higher in a series of rallies and reactions. We go up, we go back down. We go up, we go back down. Overall, we might still be going up if we're in an uptrend. In a downtrend, the exact opposite is true. We don't just go down in a very, very linear fashion. We go down, we pop. We go down, we pop. You can see that in something like the early 2000s or 2007 to 2009, the Great Recession. We moved lower by substantial percentages, but we did so, again, by moving lower and then bouncing, moving lower and then bouncing. So if you're thinking about the markets, thinking about this kind of move lower here in the total market, just on a percentage move kind of basis, that's what this chart is intended to show. As you can see, from the highs, we put in about a 13% move lower and we bounced by about 9%. We put in almost an 11% move lower and then we bounced about 13%. Moved lower by about 18.5%, moved up by almost 10%. We moved lower to those June lows by about 13%. We had a big 20% rally, just over 20% rally to the intraday highs, by the way. I'm not actually using closing prices here, which is something we can debate at a later point. We have moved lower by about 17.5%. Now, that's the second largest move lower of the year. So again, if you're trying to look for one of those bear market rallies, we're getting into that territory where we typically see a snapback rally. Whether that's going to be 2%, 5%, 10%, 20%, or is actually going to be the low, we don't know. But again, if you want to kind of be a little bit more risky, put on a couple of short-term trades as you look for one of these bear market rallies, we are stretched on a percentage basis. It's been about 17.5% moving lower, pretty uninterrupted. So I am definitely expecting us to see a bear market rally here pretty soon, something like what we saw off the June lows. But again, I'm watching those downtrends, watching those moving averages, thinking about my stoplight, and anything that I put on is really going to be nothing more than a short-term kind of bear market rally trade. Now, the final chart that I want to leave you with, I've got one more. It's just a simple note. Remember, when we have these long bull markets, coming off of bear markets, putting in lows and moving up to new highs, you don't have to nail the bottom to take advantage of some of these long-term trends. Here's our 2009 low. If you missed the 2009 low by 25%, you let the market rally 25% off those lows before you bought anything, you still put in a 646% run to the upside by the time we got to the highs earlier this year. So remember, it's tempting to want to call one of these bottoms, but if you're playing that longer term time frame, if you're putting long-term capital to work, these can be great levels to buy at, but you also don't have to nail the bottom to take advantage of some big gains, get some big profits into your account. So that is our show for today. Again, you can follow any of my work. Check out my other website, stockmarketmastery.com. Check out either of my books, Tensile Trading, The 10 Essential Stages of Stock Market Mastery, or Trading for Dummies as well. Actually doing a new version of that coming out next year, so look for that. And of course, would love to follow you, would love to hang out with you on Twitter, bounce some charts around. I'm always posting fun stuff there, so on Twitter, @Grayson Roze, find me there. if you are on social media. Remember, you can also follow my show Fridays, our product focus show on StockCharts TV called StockCharts in Focus. We really dig into the site and ultimately show you around the tools and features, but try to help you get more value out of StockCharts. I want to thank you so much for watching. Again, my name is Grayson Roze, Vice President of Operations here at StockCharts.com. I will be back with you soon, but until then, chart on, my friends.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.